Welcome to the Retirement Planning Show, your source for financial strategies to help you retire with confidence. Featuring Chip Coughlin of Retirement Income Analysts in Syracuse, New York. Chip is a registered representative, and securities are offered through LPL Financial, member of FINRA SIPC. Investment advice offered through Stratus Wealth Partners, Ltd. Retirement Income Analysts and Stratus Wealth Partners are separate entities from LPL Financial. And now, here are your co-hosts, Matt Halloran and Chip Coughlin.
Last podcast, we talked about bonds and different investment categories. Today, we're going to talk about owning individual types of investments. So, Chip, how are you doing today, man?
Hey, it's a great day. Good to be with you.
Good. Well, it's wonderful to have you and to be able to glean some of the 20-plus year knowledge that you've got going on here. So let's talk about owning investments. Where do we begin?
Well, let's talk about owning. And you can own or invest by purchasing ownership in a company or an asset. It's pretty simple. This is often referred to as purchasing an equity investment. So you're purchasing a part of a business. And by investing in stocks or mutual funds, or you're predicting that the company or the asset that you're buying will hopefully increase in value and provide perhaps some income as well as appreciation. And hopefully you're making an informed prediction based on your own research or the research of a qualified professional financial advisor. Because many times people hear hype and they say, oh, this sounds great. And I got to tell you, again, it comes back to in America today, we read the cover of the book many times, but we don't read the book.
Sure.
And we have a very strong research base. So when you're making a purchase or of an asset and you're going to own that asset, like a stock or a mutual fund that's involved in stocks, let's make an informed decision by having good research.
And that's your job, right? So part of what you bring to the world of financial advising is your job is to read the actual book from cover to cover, because we really don't expect clients to do that, do we?
Well, it's really tough. There's so much literature out there. There's so much in the media. There's so much advertising. And people, the advertisers are trying to influence people by flashy headlines, by stating very short facts without telling the whole story. So my job is basically to do good research, because we think good research will lead to good investments, and good investments will lead to or should lead to a good return. Of course, there's no guarantee, but it should lead to a good return. Mm-hmm. So better research is better long term.
Well, let's talk about the different kinds of investments. There's different types of equity investments. What are the major categories?
Okay, well, all types of equity investments share the following characteristics. Number one, value. The value is based solely on supply and demand, and that's a big part of determining the price. Capital appreciation, that's the potential for the investment to grow in value. How about income? That's investments that may pay dividends. People want income, when they're retired, so they want to make sure there's a strong dividend there that's predictable, that's going to continue over time. And lastly, we talk about an inflation hedge. Inflation hedge, we want returns that outpace inflation over time. And let's face it, when people are getting ready to retire, they want stability of income, and they want an income that will offset rising prices, which is inflation over time. So owning investments may involve more risk, but they have the potential to provide excellent returns over a long-term period.
Gotcha. So let's talk about stocks. So this is what most people, hear about when they hear the play-by-play of the Dow Jones or the S&P. Break down really what a stock is.
Well, I tell our clients, if you've always wanted to own a business, but you don't want to start your own, then take a look at investing in stocks. When you buy a stock in a corporation, you own a part of the business, including any assets such as buildings and inventory and so on. And corporations divide their ownership into shares of stock of that corporation. And typically they could be publicly traded, like on the New York Stock Exchange, or they could be privately held. And, you have an ownership interest. You have the right to the appreciation if the company goes up in value. If you make a bad decision, you will also suffer because the company will go down in value. So again, good research increases perhaps the probability that it will be a good decision and that company will appreciate in value.
Well, what are some of the advantages of owning a stock, though, besides all of the things that you just said there about owning the company and or owning a piece of the company and, potentially, being able to, feel like you own a business without taking the massive risk of buying your own or starting your own business? What are some of the other advantages of owning stock?
So if you own stock, you have great liquidity. Common stocks can be purchased and sold quickly and without a penalty. So you, instead of buying a business and outlaying several $100,000 to buy a business, you can buy shares of stocks and you get complete liquidity so you can get in and get out. If the market starts going bad, you can get out. Additionally, owning stocks gives you, if you play it right, you can get some diversification. So if you want to buy stocks in a certain industry, okay, say transportation or healthcare or financials and banking and things like that, you can buy the stocks of several companies because diversification reduces risk. Let's talk a little deeper now. If you own stock, you get voting rights. If you own shares of a company and it's common stock, it gives you the right to vote on company decisions. So you have a say in how that business is managed and where they're going to go in the future. And your decisions would be, perhaps being involved in the election of the board of directors, whether to merge with another company. Since the decision-making power is based on the number of shares you own, most shareholders do not exercise their right to vote because they only own a few shares. But if you own quite a few shares, you definitely have some power there, and you can decide what to do and what's in the best interest of making the company grow. But there's also other advantages like capital appreciation, and we talked about that. If the company performs well, the price of your stock may increase and become worth more than you invested, and that's really where we're going. That's what we want to happen. Secondly, you could have dividends. And as a stockholder, you may receive current income from the company without having to sell your shares. This may be paid to you in the form of company earnings or dividends. And as I said earlier, there's an inflation hedge. Historically, stocks prices have usually appreciated faster than the rate of inflation. So if you think about this in larger terms, to have an income that goes up over time to offset the effects of inflation, many times that component is owning stocks, either individually or through a mutual fund, and we'll talk about that a little later on.
Well, so those are the advantages that we have for stock ownership. What are some of the disadvantages?
Well, there's always disadvantages, and you have to weigh the pros and the cons. But the disadvantages for stock ownership, one would be there's no insurance. Unlike cash investments at the bank, your investment is not insured by the FDIC or any other agency. So if the company gets hit with a huge lawsuit and the price per share goes down, you're going to suffer there, okay? And when you own stock, while you own a share of the company, there's no promises, unlike bonds, where they promise to repay your investment principal. So if the stock goes down in value, you're going to lose money with that. So there are some disadvantages, but you have to weigh the pros and the cons.
Sure.
If you're in it for the long haul, many times the pros significantly outweigh the cons.
Sure.
But again, good research leads to good selection, leads to a better future.
What is the secondary market?
Okay, well, this is kind of interesting because people don't really understand where those stock shares come from. So unless you buy the stock during the initial public offering, okay, you're not buying from the company, okay? Instead, you're buying the stock from other stockholders through regional or national stock exchanges. So you're buying from somebody that wants to sell. And the primary U.S. stock exchanges are the New York Stock Exchange and the NASDAQ. And each stock exchange has its own set of listing criteria that corporations have to meet so that stock can be traded on that exchange. So we always hear about the New York Stock Exchange. That's the epicenter of the world in terms of financials. But there are other stock exchanges as well. And the NASDAQ, with the advent of technology companies, has been the place where you see a lot of the higher tech stocks going to initially, because they're smaller companies. They've got a lot of technology. It's very difficult to rate those companies because they haven't really hit their stride yet, but they're banking, on a bright future. So you'll see the technology stocks, and smaller company stocks on the NASDAQ.
Okay. Well, so you just said that instead of buying stock from the company, you're buying stock from other stockholders through the regions, through the national stock exchanges. So how are prices determined?
Well, the stock price and the price of each share that you're buying is based on supply and demand. Simply put, if there's more buy orders than there are sell orders at the current market price, the price will go up until enough sellers are attracted. So it's that supply and demand again. And what they're saying here is, if the price goes up, you're going to attract people that wish to sell. And that's how you're going to be able to buy those shares. Now, conversely, if there are more sell orders than there are buy orders at the current market price, the price of the stock will go down until they reach that equilibrium where people are willing to trade dollars for shares.
Okay.
And I'll tell you what, the demand for a stock is determined by many factors. They would include company revenue, earnings, potential for growth, current and expected conditions of the stock market, and the economy as a whole. So all of those play into the fact, is this stock going to go up or down? And as we know, the prices of stocks go up and down every day and during the day. So it depends. And you can see different events over time where, the stock market started off in the right direction in the morning, something happened nationally, and the stock market went down during the day. So it's not always going in one direction throughout the day. It certainly moves around in both directions, up and down.
Well, let's move to stock categories. So there's lots of different ways that stocks are categorized. Let's walk through those.
Well, there's different stock classes, different share classes. So companies issue different classes of stock that may appeal to investors with different objectives. There are two basic classes, common and preferred. You may own common stock shares, you may own preferred shares, or both, but there are always distinct types of ownership in a specific company. But I will tell you, most publicly traded shares are common stocks. And that's probably what we'll center most of our discussion today on. Okay?
Okay.
Because common stocks provide greater potential for share price appreciation over preferred stocks. Common stocks have voting rights. You get in there and you get to say what goes on in the company. You get to elect the board of directors and so on. But they are the last to receive any investment back if the company goes out of business. So you get a lot of say, but if the company goes bankrupt, you're last in line in terms of liquidation preference. And the common stocks, it directly participates in the success or conversely the failure of the company. Now, if we compared that to preferred stocks usually offer greater price stability, okay, but less potential for appreciation. So they're more stable, but they don't have wild swings, okay? Secondly, you don't get voting rights with preferred stock, okay? Then in terms of the company going under, after the creditors and the bondholders, but before common stockholders, the preferred stock would receive money back on their investment. Okay, so preferred stockholders, and that's why they call them preferred, they're in line in front of the common stockholders in a liquidation. Preferred stocks usually, many times, have dividends, and they're fixed regardless of how the company performs and are paid before any dividends on the common side. Again, preferred stocks. Think of preferred. The dividends on preferred stock come before they're paid to the common stocks. And the last point is very important, I think. If the company's unable to pay their dividends, they will be repaid in the future, but before any dividends are paid to the common stockholders. Again, the word preferred. They're first in line.
Okay.
All right? Or ahead. Don't say first in line, but they're ahead of common stocks in line.
Gotcha. Well, and the person who would be in front of them would be the bondholders, I'm assuming, correct?
Correct. Yeah, because again, from our last podcast, the bondholders, there's a promise to pay them because you're loaning money to the company in the form of a bond, and they would get first crack at the liquidation proceeds.
Well, let's talk about corporate earnings and how you are continuing to categorize the different sorts of stock.
Great. This is great. We're getting in good today. Growth and income stocks are vague classifications referring to how they use any corporate earnings. Some companies may fall into both categories since they reinvest their profits, but they also pay out dividends to shareholders. So let's talk about a growth stock. Growth stocks reinvest earnings in order to grow their business. They're purchased with a primary objective of capital appreciation, meaning the price per share will go up. And growth stocks are often smaller companies because they're reinvesting everything to increase their price per share. They're reinvesting to make their business bigger and better over time. Now, compare that to income stocks. The income stocks pay dividends to their shareholders, so they're designed for that. They're purchased with a primary objective of generating current income, and income stocks are often larger, more established companies that kick off stable dividends over a period of time. And you can screen down companies that pay dividends and look at how long they've paid their dividends, if they've increased each year, how they've done over time. And those are some of the really interesting companies that we find out there, because our companies are looking for stability of income, and companies that pay dividends on an increasing basis year after year over time are companies that are very attractive in that regard.
Sure. Well, let's talk about small cap and large cap.
Okay, well, the size of the company matter, and it's often characterized by market capitalization or market cap, as they might talk on the news. Market capitalization, just so everybody understands, is calculated by multiplying one price per share by the number of outstanding shares. So one price per share, $17.50 if that's times the number of shares outstanding if it's 10 million, and you can find out the market cap of that stock.
Okay.
And the exact market capitalization amounts and how they're labeled vary with different firms over time. But small cap stocks, okay, these are companies with a market capitalization of $2 billion or less. Small cap stocks may be less stable during a bad economy because they're smaller. They don't have large markets. They might not be all over the world. But they have more potential for growth, but they may also, in some instances, pay dividends. Now, if we compared that to large cap stocks, they have a market capitalization over 10 billion or more, okay? And large companies are more stable in times of volatility, and they're more likely to pay dividends, but also may offer some growth potential as well. So the difference between small company stocks and large company stocks is tremendous, and it can be seen over time in the volatility, how the price changes depending on market conditions.
Got it. Okay, well, we're really getting deep here, so let's continue, because you just outlined an enormous amount of different things that people need to know before they become individual or do-it-yourself investors. So let's talk about that, though, right? I mean, the breadth of knowledge that you have as a financial services professional over the many years you've been doing this, I've been doing this for a while too, and there's a couple of things you said that I didn't know, right? So do-it-yourself investing sometimes to me seems a little bit risky. And, there are some people who think that they can do it better than anybody else. So let's break that down in this last part of the podcast.
Well, many people approaching retirement don't want to select and monitor their own investments for several reasons. And we found this over time. And the reason being is many times you need extensive knowledge and experience, okay, to be successful at this. And sometimes it's better to pay a fee for that knowledge for someone that's done it for a while that has a good track record. Also, let's think a little deeper. A large capital investment is required to build a diversified portfolio. Okay, diversification reduces risk. So to have a diversified portfolio or to reduce risk in your portfolio, many times it takes a lot of dollars to get very diverse. I'll tell you, we had a client come in and she thought she was very diverse, and it really tells the story. She had CDs, certificates of deposit, at 8 different banks. So she thought she was very diverse. And I had to break it to her easy that while you've got diversity in the number of banks, the investment you're choosing is the same at all 8 banks. So you've got the same investment 8 times over. So she wasn't that diverse. And when you invest small amounts of money at the bank, under $100,000, you get FDIC insurance. So she could have had all those assets at one bank and saved herself a lot of time. But to be diverse, you have to invest in multiple companies. They can have similar investment objectives. And we seem to get that very well, either through a large stock portfolio or for smaller investors through mutual funds. But let's move on. I tell my clients discipline is required to avoid emotional investing. And we call that the greed-fear cycle. And we could spend an hour on that. But basically, when the market's going up, all investors think everybody's making money. It's when the market goes down, they think they're the only one that lost. And it's like the gambler mentality. They only talk about the winners. People don't talk about the losers. So what happens is people become fearful as the market goes down, so they get out and they go to cash. And they don't get back in until the market has made the turn and headed up in the right direction, and they miss the bottom of the market. So without strong discipline and a strong focus, they miss the top and they miss the bottom of the market. And we tell it's not picking the right time to get in and get out. It's getting in, staying in, and reinvesting along the way.
Sure.
So it's the time in the market, not so much trying to time the market. Okay, moving on. It takes a lot of time and effort to select and monitor the investments. Okay, we find our clients in retirement don't want to take that time. They want to be out playing golf or sailing or visiting the grandkids. And how about selection? Selection should complement the goal of a comprehensive plan, but can you do enough research to make sure that this selection is appropriate, given your time horizon, the amount of risk you want to take, and things like that? And I will tell you, for some of the people that have come to me that have tried to do it on their own, the mistakes can be very costly. Because if they invested in the wrong type of bonds with the market that we're in right now, that could have a long-term negative effect on their portfolio. If they were in the stock market in 08 and 09, when the market really took a dive down, perhaps they got out of that market and were fearful of getting back in. And then they got in late on one of the longest bull markets ever. So you have to have some fortitude, okay, but you have to have a good plan. And that's what we try to bring to the table for our clients.
Well, let's switch gears then with that. So with do-it-yourselfers, there's obviously a lot of risks. And at some point, Chip, we should probably do a podcast specifically on discipline and the cycle of investor emotions. You touched on that a little bit there. But let's talk about professional money management. What really is the benefit?
Okay. There are several benefits to professional money management, and it's basically hiring someone to oversee your investments, help you make decisions, help you chart a path, and really being a resource for you when you get nervous about the market or when you have a question about the market, because there's a wealth of knowledge out there. But if you can find someone that can boil that knowledge down into bite-sized pieces that can give the clients the confidence they need to retire successfully, I think that's what you get with private money management or professional money management. So there's countless choices. You could have investments in mutual funds. You could have them in exchange-traded funds. You could use unit investment trusts. You could use individually managed accounts. You could use variable annuities. All of those are out there. But the advantages, I feel, of professional managed accounts include professional investment research, okay, finding experienced portfolio managers with a track record of success, a smaller investment with professional money management can achieve greater diversification, okay, and there may be additional opportunities out there through professional money management to enhance your portfolio and reduce risk in your portfolio. And let's face it, we had a client in the other day, I'll give you a quick example, and he's going to retire in 9 years. And we did a little calculation through software on our computer, and we figured out that to achieve his goal, he needed to earn 6% a year for the next 11 years to get to where he needed to have the monthly income necessary for him to, be successful in retirement. And 6% is not pie in the sky, okay? We don't guarantee 6%, but if we look at the markets and how they've done over time, 6% is very reasonable. On the other hand, if we did a calculation and he needed to get 12% return for the next 9 years to achieve his retirement goals, that would be very risky.
Sure.
Because getting 12% a year every year, there's absolutely no guarantee that's going to be even close. So, time mitigates risk. In his case, 11 years was okay. Mm-hmm. But the prudent investor would say, why take more risk than is necessary to achieve my goal?
Right.
And again, we're looking for stability of income and stability of return. And if we look at the markets with a historical perspective, we're going to see that, and the client's going to get that idea.
Right. Well, the next phase that we're going to go through is mutual funds. So that's really where professional money management really, not just somebody like you, Chip, but also somebody who does all of the research and selects the different funds. So I think we've got time to get through this today. So let's just jump right into what are mutual funds and really how do you choose over the 8,000 mutual funds that are out there?
That's a great question, and it's a question that comes up time and time again. Let's look at mutual funds as our first professional managed fund. And a mutual fund, by definition, it has a specific investment objective, and that objective is always stated in the prospectus. I tell my clients they should read the prospectus. And what they do is they buy stocks or bonds or a mix of the two to achieve that investment objective. But when you buy one share of a mutual fund, you may buy 50 to 100 to 120 different companies, all with a similar investment objective. So that one share gets you tremendous diversification. But selecting the right fund, that can be a challenge. There's no question about that. There's 8,000 out there. I'd like to think that if you divided the mutual funds, there's the good, the bad, and the ugly. That's a little simplistic because everybody's trying to do well. Some funds do better than others historically, and they have done over time. So in our universe, we look at the funds that are out there, and we try to select the top-tier funds all the time. And we want to manage those so that if a company falls apart for whatever reason, could be a manager change, it could be a number of factors. If that fund falls apart, we're monitoring that fund, and we would make a switch to one that is a better choice. But if you choose the right funds, I really believe it will drastically reduce the amount of time and effort that is required to monitor a portfolio. And again, you get great diversification. So instead of buying 10 shares of one stock, you could buy 10 shares of a mutual fund, and you're purchasing shares in 50 to 120 companies. So diversification reduces risk, and that's a good thing. So let me give you a little bit more intel on mutual funds.
Yeah, no, that'd be great. Okay? Keep going, yeah.
Yeah. The funds are designed with a specific investment objective, which helps you in terms of what fund you want to choose. They provide diversification, and they provide professional money management. For example, the manager of the mutual funds, it could be one manager or a group of managers, would decide what companies to buy and sell. So they're scrutinizing through research what's going on with all the stocks that are in their portfolio, if it's a stock fund, and they're deciding which ones to sell. This company's not doing well, let's get rid of this one. This one's doing well, let's pick that one up, okay? And the fund company and the managers, they select the investments or the funds with certain criteria. So I like to refer to that as the magic of the manager. And there's a metric we look at in our portfolios for that called alpha. Alpha is excess return over a constant, and it's attributable to the manager or managers of the funds. So we're looking for positive alpha. And, the guys that have done really good. And again, it's like pitchers in baseball. They don't last forever. So they might have a hot streak and then they might cool off for a period of time. But we always want to have top tier funds. The consistency of the mutual fund is very important because they're buying stocks. It could be growth or value, large or small, mid cap, and they're buying companies that fit that investment objective. But I will tell you, occasionally we track the funds and we track what they buy. Occasionally, the fund manager will go against their stated specific investment objective, and they'll buy stocks out of their category. And we call that style drift. And by observing or by researching what they're buying consistently over time, we try to avoid style drift because we feel on our end that the more they adhere to their stated specific investment objective, the more predictability is built into the funds that we use.
Gotcha.
So it's the case where the example I use is in America today, we read the cover of the book. We don't read the whole book. And if there's a fund out there that says, oh, they've got a great return, it gets positive press. Positive press brings new assets in the front door. But to be included in a portfolio that we would manage, they have to have a track record. They have to have stability of management. And they got to do what they say they're going to do. Because if they drift away from their stated specific investment objective, we want to get rid of that fund because it's not going to be as predictable as we want in our asset allocation model.
Sure. So I'm going to leave this to you here. Do you want to dive a little bit deeper into what it means to invest in prospectus and all that stuff, or do you want to get into the fund categories? Because we don't have time for both today.
Well, let's just talk a little bit more about investing in a mutual fund.
Okay, cool.
Just so people understand. And the word mutual fund is bandied about, and everybody thinks, oh, how does this work? Well, when you buy shares of a mutual fund, your money is pooled with the assets of other investors. So think of the word mutual. And you can choose to have your profits or distributions paid to you in a check. You can have them deposited in a different account, or you can have them reinvested in the fund, which is a good way. We tell our clients, hey, if you're accumulating money, reinvest the profits, buy more shares, because more shares is how you're going to get ahead. The fund company, and this is the managers now, manager or a group of managers, they take care of the administrative tasks and they provide the client with regular updates on performance. That comes through, it's seen in the prospectus, it comes through in your monthly or quarterly statements, but they also take care of any taxable earnings and they report those to the IRS even if you reinvest. So you don't have to worry about that. The IRS is going to get notifications of, short-term gains, long-term gains, and things like that. It's very easy. There's an ease of operation in mutual funds. Again, diversification, ease of operation. You can pick the right fund for the asset class that you want to fill, and you can monitor it. And as we do, we monitor the heck out of them because we're monitoring the managers, we're monitoring the return, we're monitoring what they buy, we're monitoring the inflows and outflows and how they handle those. And there's a lot of factors that go into determining if it's a good fund and if it's appropriate for your portfolio. It's not just, they've got a great return. Well, right. Sometimes they look like a comet. They burn very brightly for a period of time, and then they fall off the radar screen. So we're looking for stability of return, risk-adjusted return, and things like that. So it's very important. But I would tell you, when it comes to the mutual funds, Matt, the portfolio manager is the one that adds the value. Okay. And as I said earlier, we call that the magic of the manager. Okay. The portfolio is only as good as the manager. And the manager is the person that's making the decisions with your money. Okay. And you want the best people in place to do that. And the investors often look at the past performance of the fund without investigating, and this is crucial, how long the current manager has been responsible for the performance of the fund. So the fund's got a great 10-year track record. How long has the manager been there? If he's only been there 2 or 3 years, he can't take credit for a 10-year performance. So when we're looking for stability of managers, okay, we want a guy that's been there for a while and has that positive alpha, that excess return over a constant. If the manager's new to, and again, you find this occasionally, if the manager's new to the fund, what we do is we look where they were before, because their track record, where they were previously, can be found out through research, and you decide whether you like them or not. Okay, is it going to is it going to be good for you? And, you want to look at the track record. Simply put, if people out there follow baseball, if the pitcher wins 20 games with the Yankees and he gets traded to Toronto, he probably should win 20 games with Toronto, everything being equal, because it's the same players, the same league, the same stadiums. So, we track the managers, and the managers add value. And I think that's very important for everybody to understand. We don't choose the fund based on the name of the fund. We're choosing the fund based on how the manager has done.
Gotcha.
Okay.
Well, everybody gets, those of us who are invested in mutual funds or the market, we generally get these books of really a lot of nonsensical stuff there. But I know that it's important to pay attention to the perspective. Let's talk very quickly, and we'll wrap up with mutual fund prospectus.
Okay. A mutual fund prospectus is a report put together by the fund that lists a lot of information that's important to the investor. And yet people just poo-poo the prospectus. In the prospectus, you're going to find the stated specific investment objective of that fund. But you're also going to find out about the manager and the tenure of the managers. How long have they been there? You're going to find out about fund operations, how they do that. You're going to find out about the types of investments that the fund may purchase, okay? And a list of the countries where the fund can invest. Many of the funds not only invest in the United States, but they may invest in other developed countries as well. If you chose an international fund, and many of our portfolios have international funds as part of the asset allocation, we want to see what countries or regions that fund invests in and see if it meets with what we're trying to do. The prospectus also tells a history of the performance, and they'll also list the top holdings in the fund. And it's a great way to see, hey, what does the fund own? What companies are they buying? Here's what they say, here's what they do. And they list the top 10 or 20 holdings in the fund. I tell my clients two things. It's kind of funny. I've only known one person that read a prospectus cover to cover. And he was my best client and my worst client rolled into one. And it was my father. And he read the prospectus cover to cover. That's great to be informed. But then he would call me out of the blue. He said, Chip, I'm reading page 17. What does this mean? And so he could reach out and get me at any point, and that was a little bit frustrating for me. But the prospectus is a great source of knowledge. Our clients receive a prospectus every year on the funds that they're in, and I think it makes for light reading just to get a handle on what's going on. And again, it's always better to be informed. And it's better, and we say this before, Matt, it's better to prepare than to repair.
Yeah, good call.
So, and I can give you an example. We had a client call us, and he'd heard about a fund, and it was really knocking the cover off the ball. The fund was doing great, but the fund didn't hold up to our strict selection criteria. And he said, what should I do? And I said, well, it's your money. Why don't you put some of your at-risk capital in this fund and see how it does? But I would not recommend putting your entire life savings into this fund. And that would be, you'd look at that and you'd say, well, if he did that, it was a very concentrated portfolio. And what happened over time was that fund had a stellar year, but then it fell apart. Okay, so his at-risk capital went up and then it went down. And he learned a pretty good lesson, is that stability of return, stability of performance, having good managers that have a long tenure and a great track record is very, very important, rather than, yesterday's news of a rising star that crashes back to earth. Yeah. So, yeah, you really have to watch that. And it's not magic. It's research.
Gotcha. Well, it's not just magic. It's research is where we're going to leave it today. So, Chip, thank you very much for your wisdom and your knowledge.
Okay, Matt, pleasure to be here.
And next time, we're going to talk a little bit more about mutual fund categories, and then we're going to get into ETFs. So we'll see you very soon on the next podcast.
There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Investing in a mutual fund involves risk, including the possibility of loss of principal. Value will fluctuate with market conditions and may not achieve its investment objective. Upon redemption, The value of fund shares may be worth more or less than their original cost. The payment of dividends is not guaranteed. Companies may reduce or eliminate the payment of dividends at any given time.
Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Stratos Wealth Partners, a registered investment advisor. Stratos Wealth Partners and Retirement Income Analysts, LLC, are separate entities from LPL Financial. Content in this material is for general information only and not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly.